This video is for you if you are already profitable trading Forex and you've been profitable for the past 3 to 6 months and you're making anywhere from $1,000 to $3,000 per month on average pretty consistently. In this video, what I'm going to do is I'm going to teach you exactly how to scale from where you're at right now to making an excess of about $10,000 per month or more. I'm not a financial advisor. Trading is risky and most people lose money. This is just how I did it. So I've been trading for the past 10 years. My name is Nick, if you haven't seen already from my YouTube channel, and I've traded Forex, crypto, and stocks. I've made millions of dollars in all markets combined, and this is how I got from that level where I was making $1,000, $2,000, $3,000 a month to over $10K a month. All right, so you're profitable. Great. Let's get you from about $1,000 to $3,000 a month to over $10,000 a month. Here's what we're going to talk about here in today's video. There's a couple things here to consider. The first thing is the capital allocation that you have. So how much money you actually have to trade with in total. We're talking about just the money that you're willing to risk. We're not talking about your net worth. We're talking about how much money you're willing to actually trade Forex with. The next thing we'll cover is risk tolerance. This is just a reflection of how much you're comfortable risking per trade and per account. The next thing we'll talk about is timeframes. Timeframes are going to be very important here, especially if you're using lower timeframes. We're basically going to talk about transitioning up to higher timeframes, doing the exact approach you're already using, because there are more optimal ways to trade using higher dollar amounts and higher risk on the higher timeframes. The next thing here is trade selection. We're going to talk about you using your discretion, your applied experience, your intuition to basically select trades that are more likely to work out. And then on those trades, you can risk more. And then on the trades that are still worth taking, but they're just not as optimal, you'll just risk less on those while still taking them. And the last part we'll cover scaling up. All right, so let's talk about trading capital. Now remember, this is just the money that you can actually afford to risk, how much you actually want to trade with. So to make $10,000 per month trading or more, on average, you're going to need to have at least $50,000 in capital. So the reason I say $50,000 in capital is because if you use any less than that, the problem is you run into a couple things. You run into leverage issues, margin requirements, and then on top of that, the thing that you run into is that if you hit a losing streak, what will happen is you lose your account very, very quickly. So you could quickly lose 50% of your account if you're trying to do this with lower dollar amounts, given the amount of money that you have to risk per trade with a system that makes only a couple units of profit per month, which is reasonable for most profitable systems. If you don't have $50,000 to trade with and you want to go about getting a funded account or doing something like that, that's all up to you. What I'm saying is that if you want to be making high profits, you do have to have a good amount of capital to be able to do so. Otherwise, it just won't work consistently and sustainably. If you use any less money, the risk is just too high. Of course, more capital is better. So if you have 100,000 or 250,000 or 500K to trade with, that's better because then the risk becomes even less while risking the same dollar amounts. But if you have less than this, like say 25K, 20K, even 10K, and you're trying to make 10K per month on average trading, that's very, very unrealistic in my opinion. It's going to be very difficult for you to do that predictably without eventually blowing your account and potentially losing all your trading capital. So for this, you need at least 50K. Let's talk about risk tolerance. So higher profits simply come from risking more per trade. It's not rocket science. Now, a perfectly fine trading approach is likely to net you at least around 1 unit of profit to 2 units of profit per month, as long as you factor in all the losing streaks and the break-even periods. I myself average 3 to 4 down or break-even months per year. There's periods of time where I go through a month or two where I make $100,000 to $200,000 in profit, and then I spend the next 2 to 3 months just grinding out at break-even. And then I have another big win streak where I make 100, 200, 300K in profits over the course of a month or two. And then I have another set of few months after that where it's slightly losing, or losing half of what I made. Or I make a little bit of profit or barely any, and it's basically break even. You want to make sure you're able to factor in and account for all those losing streaks, win streaks, and break-even periods, which is why I think it's perfectly reasonable if you're risking high dollar amounts per trade to just come out 1 to 2 units of profit per month. If you can just come out 1 unit of profit per month and you're risking $5,000 per trade, and out of every 10 trades you take, let's say, you win 6 of them and you lose 4 of them, you're making $5,000 per month. So pre-tax, that's about $60,000 per year. You double that if you make around 2R per month on average. And if you're doing that, you're making over $100,000 per year, which is basically exactly 10K per month. So to do this, you're going to have to be making at least 1 to 2R per month on average. And I think that's perfectly reasonable for a trading approach that works. So therefore, with enough trades per month, let's say 10 to 20 trades per month, that's about, anywhere from 2 to 5 trades per week. About 2 units of profit per month is equal to about $10,000 in profits, and that's going to require you risking around $5,000 per trade to do so. If you're risking $5,000 per trade, you come out about 2R per month. That's going to give you about a 10K profit in total per month pre-tax. So $5,000 per trade is about 10% of a $50,000 account. Now, the reason I suggested 50K is because this gives you a losing streak of about 8 to 9 trades realistically in a row at full stop outs where the stop loss is before you actually blow an account. Blowing an account is really not something you want to do, especially if that's all the money you have in your trading account. That's why I suggest this risk structure, because while you could lose 8, 9 trades in a row or more, if you're using a very simple system with higher time frames, you're using dynamic trade management to get out of losses early, to hold winners a little bit longer, and your win rate sits at about 50%. It can be like 40 to 60%. But as long as you make more on your winners than you lose on your losers, that still gives you enough insulation from the volatility curve and hopefully the uptrend of your trading account growth and equity growth to be able to actually make a consistent profit. So doing this requires that you're going to have to be having a system where you recognize you're going to be losing 2, 3 trades in a row. And with the high risk, right, 10% per trade is pretty high risk. But if you're doing that and you're doing it in a very structured way and you're already profitable and you have a working approach, to scale it up, to do things like this is going to make things a little bit more uncomfortable, and you're going to have to push past that to be able to get to that next level of your trading journey where you can actually start generating profits that are bigger. All right, let's talk about time frames. So lower time frames. A lot of people scalp. A lot of people do this stuff where they're trading the 5 minute, the 1 minute, things like that. There's nothing wrong with that, particularly if you have lower amounts of capital or if you're using a prop firm and you have tight spreads or no spreads and really low commissions. But lower time frames simply require more time spent on the screen. It also costs you more money in terms of commissions. The swap fees are larger, even on Wednesday, whenever you're trading Forex, because you get triple swap fees on Wednesday and you get normal swap fees the rest of the day. They can sometimes be really high. You also have to worry about higher spreads. If you're trading on a lower time frame and you have a 10 pip stop loss and a 10 pip profit target, sometimes 1 to 2 pips of that is just going to be chewed up in terms of spread. So really, you have to risk like 8 pips to go for like 12 pips. Factoring in for the spread, because both the bid and the ask line have to move to the profit target for you to win, but only one of the bid of the ask lines have to move to the stop loss for you to get triggered out at a loss. So it just makes it way more of a pain in the ass whenever you're doing it on lower time frames. You're also going to have to use super high position sizing, and with that higher position sizing, it comes with like getting like crappier fills, and on top of that, the more commissions and swap fees with the higher the position size you have. You also have to worry about liquidity spikes hitting your stop losses more often, meaning whenever price whips around one direction or another during like news events and stuff like that, you're going to have to worry about getting your stops hit more on news events and things, just because you're trading on a smaller time frame and the market can move a lot more quickly over the course of a few pips than it can over the course of like a couple of days if you're using higher time frames. And the last thing here is you get suboptimal fills for entries and exits. So you can like enter a trade, you think it's going to be entering you at a certain area. From the moment you put in your trade, you're typing in the position sizing, you're doing the risk structure, you're dragging the stop and profit target into place. And then you find that by the time you click buy or sell, price has already moved away from the region that you were going to enter at, sometimes a couple pips, and that completely screws up the risk structure. Those are all the things you have to deal with if you're trading lower time frames, and then they're magnified whenever you start using higher risk on it. So moving to higher time frames solves this problem. The trades are generally more reliable. And what I mean by more reliable is I just mean that it's so much easier to be able to buy or sell at a support resistance zone on the higher time frames like daily and weekly, because from my experience, I'm utterly convinced it just works out easier on the higher time frames. It works out better, it's more reliable, it's more predictable, more consistent, more sustainable if you're doing it on those higher time frames as compared to if you're trying to do this using a 1 minute chart support resistance zone. Price just tends to respect higher time frame zones a little bit more clearly because there's more eyeballs on the market and there's more capital coming into the market at those zones. More people are taking their profits at major support resistance zones. More people are entering at those zones. They've got their stop losses past it. There's just more liquidity and orders that are coming into the market at those major support resistance zones in the higher time frames. So it makes it way more easy and more reliable. The next thing here is that there's less time involvement. If you're trading a daily chart or a weekly chart, there's often times where you really only have to look at the chart once or twice a day because the charts don't move much, right? Even if you're trading daily or 4 hour, there's not really a lot to do, right? You have to look at wherever you want to enter the market at, set an alert there. Whenever price gets there, you get an alert to your phone or to your TradingView application, and then you can go and you can actually place that trade. And if you really wanted to, you can even just set limit orders. I don't set limit orders because if price gets into a zone and immediately spikes past it, you can oftentimes avoid that by just setting an alert, and then price gets to the zone. Then you go and check the chart to make sure price hasn't instantly broken the zone and it's not like flying past it. And then if you do that, then you're able to actually account for the context, and then you can take the trade given the fact that it looks like it's not going to break the zone immediately, at least. So there's way less time involvement. You can spend 15 to 30 minutes a day, or really even less. There's lower commissions and swaps. There's lower relative spreads and position sizing. So for example, if you're entering a trade and the stop loss is 100 pips or 200 pips, and the spread's like 1 to 2 pips, right? If you have a 100 pip stop loss and the spread's 2 pips, that's like, it's a factor of 50, right? So it's just only 2% of the actual stop loss location. Whereas if you're using like a 10 pip stop and your spread's 2 pips, that's like 20% of the stop loss distance is already chewed up and already taken from you in terms of just the spread. And then on top of that, you have commissions. So with this, with the lower relative spreads and position sizing, the spread is almost like zero if you're using like a 100 to 150, sometimes 200 pip stop losses. And it's just way easier to do that. Also, the position sizing can be radically lower. If you're using a 10 pip stop loss and risking $5,000 on a trade, your lot size will have to be whatever it is given that particular trade. However, if you're risking 100 pips on a trade and you're still risking $5,000, since the distance of the stop went from 10 pips to now 100 pips, your lot size gets to be 10 times smaller. And because of that, that means that you're going to have lower commissions and lower swap fees. It's very, very powerful. Also, volatility spikes are less troublesome. Sometimes you'll still get spiked out on a crazy news event that causes price to surge 50, 100, 200 pips in one direction. It's very rare though, given my experience. It's really, really rare, but still going to happen, but it will happen, let's say 10 times less, right? So if it would happen most times on the lower time frames, it might happen 1 out of every 10 times on the higher time frames, for example. And you also get more exact fills. So the market's usually not going to move so much if you're entering, if you look to take a trade and then you spend 60 seconds going and putting it all in and doing the risk structure and placing the trade, if the market moves a pip or two, it's not that big of a deal. So your fills are generally more exact, whether you're entering or exiting. So simply put, higher time frames are generally the best way to go whenever you're trading with larger capital. Whenever I first started trading in March of 2016, I started learning on the lower time frames. And then after trading for about 1.5 years to 2 years, I actually got profitable trading the lower time frames, like 1 minute, 5 minute, 15 minute. The problem I ran into, it might be the similar problem that you're running into if you're having trouble scaling past a certain dollar amount of risk per trade and a certain amount of profit per month. For months, I was making only about $1,000 to $5,000 per month. And to be fair, for the first few months, I only made $5,000 in a month, like in my first 6 months of trading. It was only one of those months. The other months would break even or losing, or generally like $2,000 to $3,000 of profit. I had a lot of trouble scaling from lower time frames. It wasn't until about 2.5 years into my trading journey that I started trying to find a better way to approach the risk structure for trades, given the fact that I was risking higher dollar amounts per trade. I ran into these same issues that I just told you about here on this last slide, and I was forced to find a trading approach and integrate it a little bit better to account for the context by just using higher time frames. Higher time frames are something I've used for like the past 7.5, close to 8 years now, in the past decade that I've been trading, and higher time frames have worked vastly better than lower time frames. I can still trade lower time frames, but I don't make as much profit. I spend way more time doing it, and I have to be subjected to all the pain in the ass factors that I just talked about here in this last slide. If you're going to be risking higher amounts per trade and you really want to start making a lot more money trading, higher time frames are 100% the way to go, in my very humble opinion. All right, so the next thing we're going to talk about is your experience selecting trades. Now, I want you to read this first sentence I have here. Your edge as a manual trader comes from your discretion, not a rigid system. And we're going to read it again. Please don't be distracted by the fact that I misspelled your. I forgot to put the R. Your edge as a manual trader comes from your discretion, not a rigid system. So whenever we're talking about your edge in trading, what we need to understand here is that if you're manual trading, which you are, and you're not using an algorithmic trading approach, and you're not systemizing everything with black and white, trying to use one of the like hedge fund trading approaches that use artificial intelligence and algorithms and automations to trade, and that they've spent billions of dollars and teams of hundreds or even thousands of people that develop those systems and continue to update them on a regular basis with real-time market data that you and I don't have access to. Unless you're doing that, you are a manual trader, just like me, just like most of the other people on the retail side who are profitable. And if you are a manual trader, your edge does not come from black and white systems or mechanics. Those things are useful when structuring risk, but that's about it. Technical analysis doesn't have any predictive power. All it does is it gives you a really good way of controlling risk. It helps you define where you want to enter a trade at, where the invalidation for that trade is, thus where you should place your stop loss, and then where a good potential target for that trade is. And the only reason you're going to be profitable is if you make a little bit more when you happen to be right versus the amount of money that you lose whenever you happen to be wrong. So with that being said, it's very important to structure things in a way that actually accounts for this. And the only only thing that's going to account for that is the context and the experience that you have gained as a result that helps dictate those types of intuitive, subjective discernment of price action and the types of decisions that require your discretion. Your discretion to say yes or no to a trade is your entire edge, and that all comes from your experience. Now, fortunately, if you've already been profitable for a couple months, you've already kind of learned this, right? You may not be fully consciously aware of it, but you will know that there are certain trades that for some reason you don't feel comfortable taking, even though they may technically fit a certain criteria. Price is in an uptrend, but you still don't feel comfortable buying. Price is at a major resistance zone, but you still don't feel comfortable selling for some reason. Those types of decisions are useful, and we're going to talk more about them here in this next slide. Now I have a little formula here next. It says applied experience equals discretion, and that discretion equals wisdom. So your applied experience, that just means you getting experience trading, right? So you may have been trading for a couple months, you may have been trading for a couple years, but all the experience that you have, whenever you actually apply that, what that does is that translates to you having discretion, and that discretion you can then exercise, and that's what we call wisdom. The wisdom to take a trade or to not take a trade, and the type of wisdom to do things such as you're in a trade that looks like it's going sideways or it's starting to slowly go against you. You think it's going to break past the zone that you enter. You think it's not going to work out. You think it's not going to go into profit. And so instead of holding that trade, you end up just getting out early. And instead of taking a full loss, you end up making, a small profit or a small loss or a break even. Your applied experience is going to generate discretion, and that discretion will give you the wisdom to decide what to do given the specific context. Now, choosing trades that you believe are more likely to work given your experience are trades that you should focus on. That should be the main focus of what you're doing, whilst risking more on those trades to capitalize on your edge. I'll give you an example. Let's say you find a trade on the daily or the 4-hour chart. It looks decent, but price has already tested that same resistance zone multiple times very recently, and it's continued to make higher lows as it's continued to go up into the resistance zone. So it's making higher lows, but it's making equal highs right there at the resistance zone. And so you're thinking, technically price is at a resistance zone, and technically you do have a little bit of profit potential if it does pull off that zone just a little bit. However, you do feel deep down inside like it's probably going to be breaking past the zone soon. You just don't know when. It could bounce another 1 or 2 times before continuing to make higher lows, and then it goes up and breaks the zone. And if you happen to be in that trade on the moment where it happens to break the zone, then in that case, you'll end up losing the trade. So you think to yourself, okay, let's say you're risking $5,000 per trade on average, but you have a trade like that presents itself, and you still think it's a trade worth taking, but you don't feel comfortable risking the full allocated risk amount. In this case, instead of risking $5,000 on a trade like that, you can risk a lower amount. How much do you want to risk? You'll know whenever you feel comfortable with whatever that number is. So let's say, 5,000 would be your normal risk, but it doesn't look like as optimal of a trade, right? It doesn't look like a best 10 out of 10 trade. In that case, you might choose to only risk half of your normal risk, right? So in this case, $2,500. If you're still not comfortable with that, risk $2,000. If you're not comfortable with that, risk $1,000, okay? It's okay to risk a lower dollar amount per trade. And of course, you're going to have lower profit potential, but that means the risk is lower. What this does is, the best part about this is not the fact that it's profitable. The best part about this is it keeps you from going in really, really heavy on trades that are suboptimal, right? You could have 2 trades for the trading week, and one of them is a very good high quality trade, and the second one is a trade that's still worth taking, but you don't get as good a feeling about it as you did that first one. In many cases, that first trade is likely to win, and if it wins and you were risking $5,000 on that, you're going to make at least $5,000 in profit, even if you're only using a 1-to-1 risk-reward ratio, which is completely fine. For that second trade you take, you could lose that whole $5,000 if it breaks that area and goes straight to your stop loss. Maybe the stop loss happens to be a little closer to the zone. Or maybe the context, like I just described a few minutes ago, with price continuing to make higher lows into a resistance zone on the 4-hour or daily time frame, give you kind of pause and reason to think, it looks like it's going to be breaking above this zone, honestly. Even though it's technically at resistance, it looks like it's going to be breaking above. You can still take that trade, but you can do it with a lower amount of risk. And what that does is it keeps you from essentially getting cold feet, right? You don't want to go for 1, 2, 3, 4, 5 weeks without taking a single trade because you're trying to be so freaking specific about which trade you're taking. So in my opinion, it's better to just participate in those trades still. They're still worth taking. They're still a viable risk structure. They're still optimal enough to trade, but they're just suboptimal compared to what types of trades you really want to go all in on, meaning like you're just risking your full risk allocation, which in this case, if you're trading with the bare minimum balance of $50K, that's $5,000. So with these, it gives you that flexibility to be more dynamic about the decisions that you're making. So that way, whenever you do find really good trades, you risk more. And whenever you find trades that are just not as great, you still take them, but you do them with less risk. All you need to do is you need to simply just adjust your risk per trade in accordance with your subjectively perceived quality of the trading opportunity. So risk more on the best trading opportunities and less on the others. That's all it basically means. If you find a trade that you think is really, really good and it's perfectly fine, you don't get any weird feelings about it, a trade you'd be pretty surprised if you lost, take those and just risk more on it, right? Risk your full risk allocation. And on the other trading opportunities that are still worth taking, but you don't get as motivated or as confident or as good of a feeling about them, you can still take them, but just risk less on them and risk a dollar amount that you're completely comfortable if it were to lose. That way you're not worried about it whenever you open those trades and you're sitting in them. All right, let's talk about scaling up your position sizing in an intelligent way that is not as likely to cause so much emotional turmoil as you transition into this next stage of your trading journey. So, simply put, incremental adjustments over time until you get to your target risk. I've had a lot of clients over the years that have gotten profitable trading and they were doing very well risking small dollar amounts per trade. They were trading with like say $5,000 to $10,000. They were risking $100 to $200 per trade, and they were making consistent profits, usually like a couple $100 or a couple £100 per month. And then what would happen is as they got to the point where they wanted to risk more, they would go from risking like $100 to $200 to like $1,000 of risk per trade. And the thing this does is whenever you start going to that transition, it's not even a transition, right? It's like basically a leap. What happens is a person's like emotions and their mental psychology around trading hasn't quite caught up to that level of risk yet. So while as normally you'd be comfortable seeing like, you're risking $100 per trade and you see a trade sitting in a $50 drawdown, you don't get as nervous or panicked out, right? But when you immediately jump from something like that, like $100 risk per trade up to 1,000, what happens is you might be like, holy shit, like, okay, I'm in a trade and it's halfway to the stop loss. So that's a negative $500 of drawdown. And that's like a loss that's open of my last 5 winning trades. If you had previously just won 5 trades in a row, which again, that's, it's unlikely. It'll happen, but it's unlikely. And then on top of that, if it continues to go against you, that $500 loss is going to turn into a $1,000 realized loss, and you've just lost the past 10 trades of profit. So that can be something that's very damaging to a trader's confidence, and it can really hold you back from actually getting the level that you want to be at, which is accelerating to the next level of your trading where you're making more money. And what I've also found is that more often than not, it actually produces regression. It actually takes you back a couple notches because then you start losing your confidence. You take a couple trades at 5 to 10 times the normal risk you were doing, and you go into it way too quickly, and then you end up not feeling confident, and then out of fear, you then end up pulling back instead of letting the stats play out. You start making really weird trading decisions and nothing seems to be working out. And then you go back to only risking a couple $100 per trade. And then it takes you months to build back just to where you were to get to break even. Now you've wasted all that time. And more importantly, you've sacrificed all the profits that you could have made had you just done it in a very, let's say, incremental and transitional way. So let's give another example here. So here's the example. Let's say you're risking $1,000 per trade right now. Increase your risk to just $1.5 thousand per trade for a month. So right, this is just 50% more. So this is like you risking $100 and then you increase it to $150 risk per trade, right? So then after that, let's say you risk 1.5K per month per trade, then start risking $2,000 per trade. And if you're comfortable with that, scale up to risk maybe $2,500 to $3,000 per trade for a month until you get comfortable with your risk target of, in our case, a minimum of 5K risk per trade. That's what's reasonable to be able to do this. Again, if you want to be making like $10,000 per month on average, making about 1 to 2 R per month. But if you do this, a lot of people will be upset by the fact that, okay, this is going to take at bare minimum, 3 to 4 months. And really realistically, it's going to take you 6+ months to get to this position. Again, we're not trying to get here instantly overnight. We're just trying to make sure that you get there. I'll give you another really, really pragmatic example. I used to be a patrol officer for a security company. I worked armed security, going and working at the crappiest places in the city that I lived, like apartment complexes and commercial properties. And one of the things that we did is we had a contract with the police department for the city that I worked in where we would take 911 calls that were like domestic calls and things like shootings, things like robbery, because the police department was so swarmed that they literally contracted with a third-party security company to take those same calls. So me and other officers with the security company that I was with would literally take 911 calls, usually a couple of them per week. And so in going to properties, one thing they teach us is, since we couldn't do like lights and sirens, they always taught you drive to arrive. So what that means is, like, yes, get there as expediently as you can. Don't drive like a grandma on her way to church, but drive to arrive. Drive in such a way where, you're still getting there, you're being very critical, you're not wasting any time, but make sure you actually get there. Don't start driving insane, running red lights, running stop signs, get into a car accident, and then not only do you not get there, but you may even injure yourself and others or even die. That's no way to do it. Whenever you're driving to arrive in trading, what that means is that you are doing things in a structured way where, yes, you're making progress, you're advancing closer and closer to getting to the goal, but you're doing it in a way that actually makes you more likely to get there. It's better to get there in 6 months from now as compared to spending the next 6 months going way too fast, way too deep into it, losing your confidence, panicking, starting to question reality and questioning whether or not you're even profitable. And then you end up taking all these steps back and actually regressing, sometimes to the point where you're even further back from where you even were to begin with right now. I don't want that to happen to you. It's better to happen at least like 6 to 12 months from now as compared to never happening at all, because you don't approach things in a very iterative, structured way. Just a reminder here at the very bottom, this is a transitional process, not an overnight one. Make sure you take the time doing it. All right, so the last thing I'll say is to help you do this, I have a group in Discord. It's a private Discord server. It's just read-only, where I share all my personal trades that I take. And I risk anywhere from $25,000 to $75,000 per trade. Over the course of the past 6 months live, from the time of this video, I've taken a $350,000 deposit, and then live, every single trade, have grown that account to $620,000. So it's been over $400,000 in profit, and then I have a lot of fees and commissions. My fees and commissions, even doing this, have been like $140,000. And so just doing that, and every single trade documented live with timestamps in the Discord server, it's a way to help you learn how to start structuring your trades at the higher level, doing exactly what I'm doing. My trading approach is very, very simple. It's an elegant way to just trade. I only trade anywhere from 15 to 30 minutes per day. I just use support resistance zones in the higher time frames, and it's a way for you to see that live so that you can follow those trades if you want. You could even copy them if you wanted to. Remember, nothing's guaranteed, but I show all my win streaks, all my losing streaks, and it's a way for you to follow my trades live, so that way it can kind of help you ease into this, being a little bit more confident and being able to start producing results that are actually going to get you from where you're at right now way further along, and ideally at a much quicker pace than it would take to do it on your own otherwise. So if you're interested in that, hit the link in the description and you can check that out and potentially join my group in Discord to be able to actually follow those trades live, so that way you can start learning how to structure this on your own. Most people who are clients in there stay clients for anywhere from 4 to 6 months because it helps them build up their own trading approach, and then they get cut loose and they can go do it on their own, and they can do it predictably, sustainably, and consistently. So with that being said, thanks for watching. I'll see you in the next one. Bye.